Your gold scalping, a strategy of taking many tiny profits per day, can look perfect at 9:31. Then it torches $500 by 9:34. This video gives you 3 checks. You'll spot the failure before you risk $1. Not because the idea looked stupid, not because the chart was random. In 1995, Nick Leeson lost $1.4 billion after that exact blind spot. What's interesting? Next, you'll write the loss story before the trade ever starts. So what goes on that checklist at 9:31? Not reasons the trade could work. You write 3 ways this fast gold idea could be dead by 9:34. First, price moves against you by 1%. Gold looks clean for 30 seconds, then it snaps the other way. If a $50 risk suddenly becomes $180 because you freeze, that was a bad plan, not bad luck. A 1% move in gold can happen before you finish reading the next candle. Second, the idea is fine, but the timing is trash. You enter during a wild 10-minute burst, candles stretch, the screen flickers, and your order gets filled worse than expected. On May 6, 2010, the flash crash slammed the Dow 9% in 36 minutes. Plenty of people weren't wrong on direction. They were wrong about what fast markets can do. Third, your chart isn't the danger, your mood is. You just took 2 small losses by 9:28. Now the third click has red money energy behind it. You aren't following a plan, you're trying to get even. Traders call that revenge trading, taking a bigger, sloppier trade right after a loss. That flip matters. Before the trade starts, you stop asking, can this win? And ask, how does this blow up? People call that a premortem, planning the failure before it happens, and it kills bad trades before they start, because hype hates details. The pattern is clear. At a poker table, the final card hasn't even landed yet. The bets keep getting bigger. The story is getting worse for you, not better. Good players fold before the river card, not after the panic. If this flip helps, subscribe. We do 2 clear breakdowns like this every week. Now comes the useful part. What are the exact 3 boxes you check before your hand goes near the keyboard? Looks clean. That's how rushed trades talk to you. It's 8:32 a.m. Gold is whipping around on the 1-minute chart. That's a chart where each candle, a bar showing price movement, represents 1 minute. One screen shows fast candles. The other should show 3 boxes. First box, what exact move proves you're wrong? Not if momentum fades, too vague. Name the price or the candle. If the next 1-minute candle closes back under 2,432, I'm out. That is your exit. If you can't say what kills the idea, you don't have a trade. You have hope. Second box, start with the dollars. With a $500 account, a 1% loss cap is $5. With a $5,000 account, it's $50. That dollar amount at risk is your exposure. How much of your account is on the line? Then work backward from the exit distance. If the math looks silly, skip it. Small accounts don't get to ignore arithmetic. Third box, who shows up if the first trade loses? Your calm self, or the version reaching for a faster re-entry? You take 1 loss, your jaw tightens. Suddenly you want the next trade way bigger. Traders call that revenge trading. This is not theoretical. On May 6, 2010, the flash crash dropped the Dow 9% in 36 minutes. Fast markets punish hesitation. So give yourself 30 seconds. Name the failure. Name the size. Name the exit. Name your post-loss rule. If you can't, pass. But even after that, most people still ask the wrong question. Why does the same clean chart wreck one trader and spare another? Gold is ripping at 9:31 a.m. 3 green 1-minute candles. Your screen flashes. You tell yourself, it's moving fast. I just need a piece. That sounds sensible. The beginner question is simple. Can this trade win? But that is the trap. A trade can still win and be a bad decision. Take 2 traders watching the same breakout. Price punching through a level it had been stuck below. Gold pops above 2,360. Both plan to risk $200. Both want $400 if it works. Same chart, same target, same 5-minute window. Trader A enters at 2,361.80 after the 3rd candle. He's late, but the move feels strong. Then the spread, the gap between the bid price and the ask price, jumps from $0.20 to $0.80. His planned exit now has to sit $2 lower to avoid candle noise. He keeps the same size anyway. In 1 click, his exposure, how much of your account is at risk on a trade, is no longer $200 in practice. It is whatever that sloppy exit turns into. Trader B asks a colder question. What makes this fail in the next 5 minutes? 3 answers show up fast. The entry is late. The spread widened. The exit has to sit inside noise or too far away. So he cuts size in half. Or he does something that feels boring but keeps him alive. He steps back and protects his chips. Poker players call that a fold, quitting the hand to protect your chips from a bad spot. That is the whole difference. One trader wants proof he can be right. The other wants proof the trade can survive being wrong. Here's why it works. Ego hates this part. In fast markets, your brain starts trying to bluff, betting as if you have a strong hand when you don't, the market. You act bigger than your edge, a small statistical advantage that pays out over time, really is. You tell yourself speed equals opportunity. Sometimes speed just means worse terms. The Dow's flash crash on May 6, 2010 made that painfully clear. Price moved so fast that normal exits became terrible ones. Gold does the same thing on smaller scales every week. Not because the idea was stupid, because the failure path was obvious and ignored. So the pro question is not, can this win? It is, what breaks this in 5 minutes? If the answer is late timing, widespread and noisy exit, the math says fold. Ego says bluff the market anyway. Now watch what one missed failure path did to one account in gold. March 2021. Bill Hwang was running Archegos, a family office. He had huge bets tied to just a few media stocks. Then one piece cracked. The whole structure snapped. Here's the setup. Archegos wasn't a small account taking one careful shot. It had concentrated exposure. How much of your account is at risk on a trade? To names like Viacom CBS, Discovery, Baidu, and Tencent Music. And it used leverage, borrowing to trade bigger than your actual account size. That made those bets much larger than the cash sitting underneath them. That matters. Size changes the kind of mistake you can survive. A tiny bad entry stings. An oversized one can trap you. Now the first beat. Viacom CBS had rallied hard into March. On March 22, 2021, the company announced a $3 billion share sale. 2 days later, on March 24th, the stock closed near $100. By March 26th, it had dropped into the upper $40. That was not a normal little wobble. That was air coming out fast. Second beat. Freeze the story right there. Before the collapse hit headlines, the failure path was already visible. One account, a few crowded names, heavy leverage, and if the market turned, getting out meant squeezing through the same door as everyone else. This is the exact moment your own gold scalp can go wrong. Not 20 billion wrong. But same script. You're late to the move. The candle looks fast. The spread widens. Your position sizing quietly gets bigger. You want the move to matter. So ask the question Archegos should have asked before size got that big. What breaks this in 5 minutes? If your answer is a fast reversal, thin liquidity, and no clean exit, type premortem in the comments. That one word means you're asking the right question before the damage. Third beat. Once Viacom CBS dropped, the lenders wanted out. Archegos faced margin calls, the broker demanding more money because your trade went the wrong way. Banks started unwinding the positions. When giant size has to exit in a hurry, price can drop even harder. The selling feeds on itself. That's the part beginners miss. A trade can fail twice. First on direction, then on escape. You weren't just wrong. You were wrong in a place where leaving got harder every minute. Fourth beat. The aftermath was massive. Archegos collapsed in March 2021. Bill Hwang reportedly lost about $20 billion of personal wealth in days. Credit Suisse later reported a loss of about $5.5 billion tied to the blowup. Nomura reported roughly $2.9 billion. Morgan Stanley and Goldman Sachs moved faster and took far less damage. Your account will never look like Archegos. Good. But the pattern absolutely can. One emotional trade. One oversized gold scalp. One moment where conviction, how strongly you believe your trade reasoning is right, replaces a real thesis, your specific reason for taking the trade. And that leads to the real question. What should be on the checklist that catches that failure before your hand goes to the keyboard? This trade dies if gold drops $3 in 2 minutes. Write that sentence first. That's the whole shift. Before your hand touches the keyboard, you name the failure. Then you build around it. That rule has a name, the premortem checklist. Quick aside, if this helps, subscribe for more like it. Here's the checklist in 4 lines. 1. Write the failure sentence. 2. List 3 ways the trade can break fast. New spike at 8:30, the spread widens, your stop loss, a preset price where you automatically exit a losing trade, sits too close for normal noise. 3. If even one path breaks your account rules, shrink it with position sizing or pass. 4. Set the exit before the entry, not after, not once the candle turns red. That's the difference between chasing and folding, quitting the hand to protect your chips from a bad spot. Amateurs ask, how much can I make? Pros ask, what kills this trade fast? Bill Hwang and Archegos gave the giant ugly version in March 2021. Banks lost more than $10 billion. Leverage, borrowing to trade bigger than your actual account, and size turned a bad move into forced selling. For gold scalping, that lesson lives in seconds, not headlines. So how do you turn this into a 5-minute card before your next 9:30 setup? Tomorrow at 9:25, grab one index card. Run the premortem checklist, a quick pre-trade review where you imagine what could go wrong on your next 3 planned trades. If one of them makes you pause, skip it. That single skip can save more than a lucky win. Want more plain English risk lessons like this? Subscribe. And next up, another breakdown shows how traders protect themselves when the screen gets fast and their judgment gets shaky.